I think we touched about this earlier, and this came up again. So we talked about, can you afford one? You can afford several, and that's still the case. Let's go to the next one here. All right. Every now and then I'll have a customer will say, well, can I do less than 10 or less than 20% down on a single family? The answer is yes. Fannie Mae does support a 15% down, but in my opinion, it's not prudent the way to go. Okay, so that's why I made this example here to show you why it doesn't make sense. Okay, so I'm just going to kind of briefly go through here and look at both columns here. So we've got the column on the left. Okay, that's with the private mortgage insurance or the 15% down. The column on the right is your 20% down. Now, just going down to the interest rate itself, there's actually a rate differential if you put 15% down versus 20. So you're going to get a better rate with the 20% down. Then you go down to loan to value, that's a given. Your down payment, obviously it's less with the 15% versus the 20. Your loan amount is a little higher. Consequently, your principal and interest payment is a little higher. In addition to that, you've got that private mortgage insurance on top of that higher payment. And then the bottom net result there on the left-hand column, you come up with $755 versus the $620. So what does that mean on paper? Well, you know, that $7,500 that you didn't bring to the table, for the next 44 months, you got to pay $71 a month in addition to that, which equates to $3,100 or $3,124. In addition to your rate differential, if you spread that out over 44 months, then there's another $950. So do I have this from time to time? I'll say I'll probably do maybe 2 a year, but in my opinion, it just doesn't make sense. Okay,
right,
I always
because
do
you're spending $3,100 plus almost $1,000, so $4,100 you're spending over the first 44 months, and you know you're only getting $7,500 more. So yeah, I mean, it really would only work if it made the difference between you getting the house or walking away, because you just don't have any more money than 15%.
Yeah, and the other thing is that the private mortgage insurance is an outside third-party company, and there's like 7 of them out there, and there's only like 2 that I know of that will do it for investment properties, and they're very, very strict. And a lot of times, if we are doing a loan for an individual and their rates or their FICO scores are down in the 6s, a lot of times they won't improve it. So just keep that in mind as well. Okay.
And I just want to make one quick point that I'm sure 90% of people listening understand, but sometimes people don't know this. But you know, there's the difference between owner-occupied loans and non-owner-occupied loans. And since you and I are both in the investment space, we're not going to live in these properties. These are investments. Therefore, the bank requires 20% down. So if it's your primary residence, you can get away with, you know, a lot less down. In many cases, FHA loans and all these other things. But if it's an investment, you pretty much have to put 20% down, unless, per the previous slide, you want to do the 15% and pay the PMI.
Yeah, back in the good old days, Ben, before the 08 bust, we actually had some guidelines available to us where we could come behind it and do a second lien. So we'd have a first lien at 80% to eliminate obviously PMI, and then a second lien to backfill the down payment. But those are the good old days. Those went away, and you know, I think they probably should have, especially on investment properties. In various states, I'd say very, very, very few states on owner occupied that they have that equation available. I know they do here in Texas to have a first and second lien, all the way up to like 5% down, but on investment properties, it's just not available.
All right. Okay.
All right, reserve requirements. This is something changed about a year ago, and let me just kind of put all these up here real quick. The old rule was that you have to have 6 months reserves on the subject property and 2 months reserves on every other property that you may own. Okay, that has since changed. So what we do now is we take a look at how many properties or how many loans that you have, and we come up with an aggregate loan amount. So for mathematical purposes, let's just say, okay, I have 1 to 4 loans, and let's just say I've got 2, and my 2 loan balances are $50,000 a piece. So I have $100,000 of outstanding loans available. My reserve requirements is 2%. So for that, basically I have to have $2,000 in reserves, okay? The same math goes up, as you can see on properties 5 through 6. If it comes up with a total of 100,000, now we're at 4%, which is $4,000. And then of course 7 and 10, it's $6,000. And the good thing about this is the primary residence does not count in that equation. So that's a good thing. So just keep in mind, whatever your balances are on your loans, go do the math, okay? Do I have enough in my non-liquid account or whatever the case may be to have reserves? Because people don't understand reserves. They really don't. They think they need to have a whole bunch of money to invest, and they have to have an ample amount, but they don't have to have as much as they think. As long as I can prove that they have enough for the down payment, closing cost reserves, beyond that, I don't care what your asset and portfolio accounts look like. I really don't. So that's the new down payment, or excuse me, the new reserve requirements through Fannie Mae.
Got it.
Now,
all right, hey Graham. So now we're gonna have to pick up the pace a little bit because it's 50 minutes past the hour, but we started 5 minutes late, so we'll run 5 minutes late, but just be cognizant of the.
Let's go real quick then. Top 10 mistakes, and this is where the loan officers are going to thank me because it's amazing. And I put down there on the far right, the smartest people can make the dumbest mistakes, and it is so true. Okay. Number one mistake: not being forthright with the loan officer up front about everything. The loan officer is your friend. Be forthright with him about everything because his job is to get you a loan. You and him are going to write a book, and that loan officer is going to determine which chapters in that book he thinks that the underwriter is going to want. You're going to give him all your chapters. They're going to pick and choose what he thinks he's going to need, put it together in a loan file, give it to the underwriter. They're going to come back a happy camper. They read the book, they like it, off we go. And once again, I'm going fast here. Selling a property exchange and not titled individuals. So we talked about the LLC requirements earlier in the game. The same thing applies here, okay? If you're selling a property and doing an exchange, a lot of times people that have, you can, in an exchange, you can sell almost any income property. It could be a gas station, it could be anything. But if it's not in your individual names, you're going to have to put it in your individual names before you do the exchange, because if you keep it in the LLC and you sell the property, the exchange is going to want you to put it back in that LLC, as we talked about earlier. I cannot fund the loan in an LLC. So that's first question out of my mouth when somebody says I'm doing an exchange, is I'll ask them, how is it titled right now? Okay. 3 mistakes. On a 1031 exchange, it's real simple. You sell a property. That day it closes, you have 45 days to go out and pick another property or two. And after that 45 days, you don't have the luxury of going over. If you don't identify those properties within that time period, then you're in trouble. So you want to make sure that you identify those properties. The great thing about working with Real Wealth Network is that you don't have to go out and battle on MLS to get in line and try to outbid the next person on that property and not knowing whether you're going to get it or not. Your 1031 clock is ticking away. You just don't have any know. Where you go to a turnkey provider within the Real Wealth environment, and they say, yeah, I've got this property, it's available. Okay, great, I'll take it, done. It's easy, okay? So keep that in mind when you're working with an exchange.
Yep. It's crucial.
Don't quit your job. Don't do anything radical. Just, you got to let me know. It's amazing. I had a lady worked at Intel. She was on the East Coast. She wanted to move to the West Coast. She's moving her Intel office in the West Coast. Fine. Everything was great all the way up to the day of closing. And we go to verify that she's still there. And she goes, oh no, she quit 2 weeks ago. And she didn't even tell me. Why not? She goes, well, I didn't think it mattered. It does. So keep your job.
Wah, 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 wah. There goes that loan.
And this is really, and once again, this is part of being very, very forthright with me. If you're out buying, say, 4 properties, and I'm doing loans on 3, and that other one you're paying cash for, you at least got to tell me about it, okay? Whether you're going to close before we do these loans or after, okay? Because if you're closed before I do these loans, I have to take that 4th property into account for at least the liabilities on the insurances as well as the taxes. And of course, if it has income, we'll give you that as well. So keep that in mind. When you're out doing these, make sure you disclose everything to me up front. This happens a lot, especially during the summertime. People want to, we're in the middle of a transaction because it's not an owner-occupied transaction. transaction. So it's not that important. They're not having to get the van ready to go move their stuff. They're just buying an investment. And all of a sudden, well, we're going to, we're going to be out of the country for 3 weeks. Well, guess what? That's going to slow us down. The seller's not going to like it. So once again, be forthright with me on your travel plans, especially during the whole loan processing time period. Doesn't get pre-approved before they sign the contract. And I think in the real wealth environment, the luxury for most of those guys, they won't accept a contract without a pre-approval. Ben, you're welcome to step in here at all.
Oh yeah, we go out of our way to say, please get pre-approved with one of our lenders, Graham being one of them, before you start calling our property teams, just because they don't want to spend time with somebody who, at the 11th hour realizes, whoops, I guess I should have mentioned that short sale. I can't get a loan and a lot of times. So yeah, we can't force people to do things, but we really want you to get pre-approved prior.
Well, as a seller, they do have the option not to take the contract. Am I right?
Oh yeah. Mm-hmm.
Yeah. So just keep that in mind.
Yeah.
Buying multiple properties, different lenders. Okay. Let's say the guy started the loan transaction in wherever, Iowa. He's about halfway through it, and all of a sudden he comes to me, and the real wealth's got 3 more properties he wants to buy in Alabama. Great. Well, you need to tell me about all that information that you're working with the other lender, because once again, if that thing closes before mine, I have to get a lot of information on that particular loan, like the deed of trust, the promissory note, the taxes and insurance. So I have to have all that up front so I can include it on my application. And it works both ways. So I tell people a lot of times, if they're buying in multiple states, we're in all the states. Let us do it all so we don't have this problem. Okay.
Yep.
And once again, let's say they have a second home in the mountains, free and clear. It's not on their tax returns, so they don't care. And so people don't disclose it. And next thing you know, besides the credit report, it's not showing up because there's not a mortgage on it. But there's several other reports that we run that will actually show us any real estate the individual owns, wherever it may be. And if this pops up, then we have to put that back into the equation. And if there's some additional liabilities there, taxes or insurance, that can have an influence on your debt to income ratio. So once again, it's all about being forthright. Okay. And last but not least, Ben, your most favorite. As an investor, and Ben and I are both investors, and we love the people that we're working with. We trust them, but we're still buying an asset. It is so critical. And they even said this on, I think, the front slide, that it's so important that you get an inspection. And we're not talking about the 4-point inspections that a lot of the providers will provide. We're talking about a full-blown inspection. And that's for your peace of mind, because when you close on that asset, 3 months from now, something breaks or something's brought to your attention and it wasn't in your 4-point inspection, guess whose fault it is? It's not the seller's. Okay. Ben, you want to add to that? How many times that's come around to haunt you?
Well, yeah, I mean, it's like $350, maybe $400, and they almost always pay for themselves because the inspector will find something that you as the buyer are not comfortable with, and so you ask the seller to fix that. And the seller has an option. Gee, do I fix that, or do I say, nope, stand on principle, I'm not going to do it? And then there's a risk you'll walk away, and then they have to start and find a new buyer. So the seller is very much prone or incented to fix with, you have to be within reason. But the point I'm making is they almost always pay for themselves because they uncover things you wouldn't ordinarily have been aware of. Gee, there's no little door stopper in the back bathroom. Well, okay, you didn't notice that, and it seems pretty minor. But go ahead and have the seller fix it, because 6 months from now, the tenant will open the door too hard and the doorknob goes smashing through the drywall. And now instead of a $1.69 Home Depot door stopper, you have a $125 drywall repair. So it's just worth doing. And then also you have a nice snapshot in time of pictures and impressions and everything, so that if something does come up, wait a second, you can go back and look and see the condition of things. So it's just well worth it, and it just protects you. It protects everybody.
I couldn't agree more. And it only takes one time to get snake bit.
Yep. And I just got a question. Is home inspection equally important for new home? Yeah, because it seems at first like maybe it's not as important, and maybe it isn't quite as important, but talk to anybody who's bought a new home. There's still defects. There's still things that builders, they're still human. You know, the drywaller forgot to texture this one corner of the room, or, you know, it might be aesthetic, or it might be a lot more major. So it's definitely worth it to do it even
And the
with.
great thing about inspectors versus like appraisers, they dig deep, okay? And they find, like you say, the little stuff that you may on the naked eye miss. And you're right. I just built a home and closed a year ago. And if I wasn't, you know, very, very critical on everything about it, I probably would have missed it. I mean, a lot of people aren't critical. They just buy assuming it's a new home, it's going to be perfect. Well, guess what? It's not always.
Yep, absolutely.